This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 14, 2026, and this is the London session. Now, let's get into it. Gold is sitting at 4,015.95, clinging to safe haven status as the fear and greed index collapses to a dismal 14 out of 100. We are looking at a market where implied volatility, the VIX at 15.3, is whispering calm, while spot market participants are screaming panic. It is a dangerous dissonance, especially with the U.S. Consumer Price Index release due later today. Before we dig into the tape, let's look at the schedule. Today, Tuesday, July 14, the spotlight is squarely on the U.S. Consumer Price Index. That is the primary catalyst for the hour. Looking ahead, we have the Bank of Canada rate decision on Wednesday, July 15, followed by the European Central Bank's rate decision on Thursday, July 16. There is also the monthly OPEX event scheduled for Friday, July 17, which typically influences derivative positioning leading into the weekend.
The ARPEX date is a structural anchor for the week's options flow, but the immediate war is being fought over the CPI print today. If the data misses expectations relative to the core PCE at 3.41%, we're going to see immediate repricing across the board.
Here is the snapshot as of 19:14 Eastern Time. We have extreme fear dominating the breadth indicators. Gold has climbed to 4,015.95, up 0.37%. The British pound is showing weakness at 1.3361, down just slightly, but holding near its 5-day low. On the other side of the Atlantic, the Canadian dollar is under pressure, with dollar CAD trading at 1.4132, down 0.12%. Meanwhile, the Swiss franc is strengthening against the dollar at 0.813645, down 0.12% as capital seeks shelter. The broader picture is one of rotation, out of risk assets and into hard assets. Let's turn to the wire. First, headlines confirm that oil prices have climbed to a one-month high as Middle East conflict escalates. SPECTER, this directly impacts the commodity currencies we're seeing pressure in. What does that mean for the flow?
It means the risk premium is being baked into the Canadian dollar and Aussie immediately. We are seeing dollar CAD push higher and Aussie yen sit at 112.4685. The concern isn't just the price of oil. It's that this geopolitical escalation validates the extreme fear reading of 14. When fear hits that level, correlations go to 1. You stop seeing individual country fundamentals and start seeing a flight to safety. The Canadian dollar is getting crushed not because of its own economy, but because the world feels unsafe.
Second item from the wire, Fitch affirms Canada at AA+ with a stable outlook. That sounds benign, but grid, does that provide any technical floor for the loonie right now?
Structurally, yes, but technically, not really. Look at dollar CAD at 1.4132. It is trading within a very tight 5-day range, specifically between 1.41175 and 1.41898. The rating affirmation doesn't change the fact that the pair is testing the upper bounds of its recent consolidation. The technicals show a lack of buyer interest at these higher levels. The Fitch upgrade is a background noise event. The price action is telling us that sellers are defending the 1.41898 area effectively.
Third headline, Trump confirms the U.S. held talks with Iran, urging Tehran to reach a deal. This seems contradictory to the earlier escalation news, but Pulse, how does the market digest this mixed signal regarding the Middle East? Creates confusion, and confusion in a fearful regime translates to hesitation. However, the headline about oil hitting a one-month high suggests the market is leaning toward the escalation scenario, not the diplomatic solution. We saw stocks rally on news of Trump backing off Hormuz tolls, but the physical commodity prices didn't budge much. The market is treating the diplomatic chatter as secondary to the actual supply disruptions. The sentiment isn't relieved. It's waiting for confirmation that the spikes won't persist. Let's move to the most volatile pair on the book, dollar-yen. It is trading at 162.28, down 0.9%. We have a major headline noting that the key test for the next Bank of Japan rate hike is whether price rises stick. CIPHER, the COT data on yen is staggering. Walk us through the positioning.
It is an anomaly. Leveraged funds have posted a net long position of 1,696 contracts, but the weekly change is plus 91,779 contracts. That is the largest single-week directional shift across all pairs I track. Essentially, speculators are piling into yen longs, betting aggressively on Bank of Japan tightening. But here is the rub. Dollar-yen is consolidating at 162.28, right in the middle of nowhere. These leveraged longs are sitting on a knife edge.
And that is why the technical structure is so fragile. Dollar-yen is testing the lower bound of its 5-day range, which is 161.2825. We are essentially skirting the edge of the consolidation channel. If we break below that 161.28 support, we aren't just looking at technical bounce. We are looking at a trigger for those 91,000 plus contracts. The chart shows a clear lower boundary. And the volume is drying up. We are at a decision point.
I agree with Grid on the risk, but I want to highlight the VIX discrepancy. The VIX is at 15.3. That is low. It implies the market thinks this consolidation will continue calmly, but the fear and greed index is at 14. That is extreme distress. You have a situation where derivatives pricing suggests boredom, but spot traders are terrified. If dollar-yen breaks that 161.28 support, the VIX won't just tick up. It will expand violently, because the options market hasn't priced in the magnitude of that 91,000 contract unwind.
Exactly. And remember, the Fed funds rate is held at 3.62% with core PCE at 3.41%. The yield differential still favors the dollar fundamentally. Those leveraged yen longs are fighting the macro tide. They are betting on a policy shift that hasn't fully landed yet. The price rises stick narrative is the only thing supporting their positions. And if today's CPI data shows inflation staying sticky, that narrative weakens instantly. So we have a crowded trade against a macro backdrop that doesn't necessarily support it, sitting on a technical knife edge. If 161.28 gives way, what happens?
Short covering, rapidly. Those leveraged funds have to exit. It creates a cascade effect regardless of the underlying economic data.
Shifting gears to the ultimate safe haven, gold. Gold is at 4,015.95, up 0.37%. It dropped sharply from yesterday's close of 4,084.68, but it is holding above the 5-day low of 3,983.56. Grid, what are you seeing in the structure here?
We are seeing a classic rejection at the highs. Gold tried to hold above 4,050 and failed. Now it is sitting at 4,015.95, which is roughly halfway between the 5-day low of 3,983.56 and the 5-day high of 4,138.2. The volume is low. Only 7 out of 30 major pairs are showing significant movement, and gold is one of them. But it's not expanding, it's compressing. The 4,000 level is acting as a psychological magnet, drawing bids whenever it dips, but the upward momentum is absent.
And that is the danger. Compression leads to expansion. Gold is trapped in a box between 3,983 and 4,138. With the VIX at 15.3, everyone assumes the calm continues. But if the CPI print today is hot, pushing inflation concerns higher, gold might not have room to run higher. Why? Because a hot CPI print strengthens the dollar via the Fed's hawkish stance. We saw cable weaken to 1.3361, which often correlates with dollar strength. If the dollar gets a bid from inflation data, gold's upside is capped, and we could see a quick flush toward that 3,983 support.
I'd add that the rotation theme is crucial here. Capital is rotating out of commodity currencies like the Aussie and Canadian dollar and into gold. But gold is also competing with the dollar as a safe haven. Right now, the dollar index, DXY, is at 120.5, down slightly, but the internal strength of the dollar via bond yields is holding gold steady. The 4,015 level is a battleground. If we lose 4,000 psychologically, the algorithmic buying dries up, and we revisit 3,983 quickly.
From a flow perspective, asset managers are trimming euro exposure, but they aren't explicitly piling into gold futures in the data I'm seeing. The money is in the treasury bonds and the spot market. The lack of futures commitment suggests this move is more about defensive hedging than aggressive bull market participation. It's protective, not predatory.
So, gold is holding 4,015, supported by fear, but vulnerable to a dollar-strengthening CPI report. If CPI comes in hot, we test 3,983. If it comes in cool, we might see a relief rally toward 4,050. Is that fair?
Technically, yes. The 5-day range defines the battlefield right now.
Finally, let's look at the euro and pound. Euro-dollar is at 1.1393, up 0.9%, nearing the upper end of its 5-day range, which peaks at 1.14609. Cable is weaker at 1.3361, near its 5-day low of 1.33425. Pulse, the ECB decision is coming on July 16. How does that hang over euro-dollar right now? It hangs over everything. The ECB is facing the same inflation rigidity as the Fed, but their growth outlook is weaker. The current price of 1.1393 is essentially a standoff. Investors are waiting to see if the ECB will signal a pause or a cut. Given the extreme fear regime, any hint of dovishness from Europe could cap the euro's upside. The 1.14609 resistance is strong because it represents the limit of what the market is willing to pay without a clear policy directive. Until we get that directive on the 16th, this level is a ceiling.
On the chart, euro-dollar is testing the upper bound of its consolidation. 1.14609 is the key. If we break that, we open up space, but the volume isn't there yet. It's a low-volume test. Usually breakouts require volume confirmation. Without it, it's likely to reject. Meanwhile, cable at 1.3361 is looking softer. It's near the 5-day low. The British pound is sensitive to global risk appetite. Since our risk appetite is fearful, the pound is suffering. The spread between the euro's resilience and the pound's weakness is widening.
Check the COT data for euro. Asset managers are net short euro 3,665. Leveraged funds are only mildly bullish, plus 1,696. There is no institutional conviction behind this 1.1393 price. It's a dead cat bounce in a downtrend. The lack of asset manager buying means there is no fuel for breakout above 1.14609. It's purely speculative positioning, trying to find a foothold.
And that makes 1.14609 a trap. If you chase that breakout based on technicals alone, you are walking into a wall of sell orders from asset managers. The risk/reward is terrible for longs here. The safer play is recognizing that in a 14/100 fear environment, high beta currencies like the pound and euro underperform the dollar and gold. Stick to the evidence. Pound is near lows. Euro is resisting highs without volume.
So, euro-dollar is stuck below 1.14609 without volume, and cable is grinding toward 1.33425. The consensus is to avoid the breakout traps and wait for the ECB/CPI clarity. Let's tie this together. Apex, we have a market caught between two forces, the compressed volatility of the VIX and the extreme fear of the spot market, with a massive yen-long position waiting to explode and gold holding a fragile line. Where is the center of gravity?
The center of gravity is the CPI release today. Pulse highlighted that the Fed funds rate is stuck at 3.62% due to sticky core PCE at 3.41%. Grid showed us that dollar-yen is testing the 161.28 support level, which is the trigger for those 91,000 leveraged yen longs identified by CIPHER. Simultaneously, SPECTER pointed out that gold is trapped between 3,983 and 4,138, vulnerable to dollar strength if inflation data surprises to the upside. The market is not trending, it is coiling. The extreme fear reading of 14 tells us that any shock will be amplified. The technical levels grid mapped, the 161.28 support in yen and the 1.14609 resistance in euro, are merely the boundaries of the box. The catalyst inside the box is the data. Treat the pre-release period as a trap.
To summarize, we are in an extreme fear regime with a VIX that is misleadingly calm. The Bank of Yen longs are overcrowded, creating a squeeze risk if dollar-yen breaks 161.28. Gold is holding 4,015, but faces headwinds if the dollar strengthens on hot CPI data. And euro-dollar is struggling to break 1.14609 without volume or conviction. Tomorrow, we watch the Bank of Canada decision and the continued digestion of today's inflation data. Stay disciplined, watch your leverage, and respect the fear. This is ShadowQuant Forex edition. Thank you for listening. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.